You should break it down on a monthly level. You should know your incomes at a monthly level, and then what should be your investments at a monthly level. Sure. So ELSS is nothing but a mutual fund. The only difference is it invests into equity. If you're paying any medical premium to cover yourself or your parents who are dependent on you, then you get a deduction of that as well.
Hello everyone, welcome to the new episode of Cut the Noise, where we discuss the latest trends in the market. Today we have Ankit Dukania with us, who is finance head at Grip Invest. Thank you so much for coming to the episode.
Thank you, Namit. Happy to be here.
In this episode, we will be discussing about the upcoming financial year, which is 24-25. So Ankit, my first question to you is, what is the importance of starting the financial planning at the starting of the financial year?
Starting your financial planning at the beginning of a year allows an individual to manage their taxes and their finances better. So, for example, you can plan for how much PF you want to get deducted from your salary, right? Or how much NPS you want to contribute to, or what should be your HRA deduction. Generally, what I've seen is people don't do that, and they do it only when their employer asks for it. That means in January or February, there's a hefty investments that an individual makes, right? So if you take some moment to do your planning right now, it would help you those bulky meaty payments in 1 month.
My next question to you is, how can a salaried individual incorporate tax planning in their monthly investment plans, or let's say taxing plans, or let's say anything that they want to save their taxes?
Sure. So Namit, the first step that an individual should do is to identify what is the likely income for the year, and what is the likely tax on it, right? Now, once you have known that, you can. How do you know that? Is in your monthly payslip that you receive, there is generally at the bottom of that payslip you will see your total yearly income estimate and the tax estimate on it. That you can use that number as a starting point, and you should adjust for any bonus that you're expecting to receive. Now, once you have this total income, you should look at what should be your monthly provident fund contribution which is going off. Then you should look at what is the monthly NPS amount that you need to contribute to, and similarly your insurance premiums, or if you want to invest in mutual funds, then what is that amount. So you should break it down on a monthly level. You should know your incomes at a monthly level, and then what should be your investments at a monthly level. So that will help you plan it better. It would also help you avoid the rush in January, February, which would effectively mean that you're taking the right decisions, right investment decisions for your portfolio.
What are the different factors that one should consider while going for an tax saving investment option?
Talking about specifically tax saving opportunities, there are multiple opportunities available, and it's important for an individual to know to consider various criteria, various factors, right? So one is obviously what age bracket they are in. Typically, if you are younger, you have more risk appetite, so you would tend to invest more in ELSS schemes. Second would be your risk appetite. Third would be the duration of tax saving that you're looking for. Typically, the investment opportunities under tax saving, they have a lock-in period. And the fourth one is the return expected from the investment that you're making out. So these are the four criteria I would say one should look at while they select what investment opportunity they want to go for.
If you want to give an example, or let's say give few examples of the different kinds of tax saving investment options available for individuals or for anyone in the market.
Definitely. So for an individual, there are a lot of options available. The first one is obviously the provident fund, which gets deducted from one's salary every month. Second is ELSS funds. So there are certain notified ELSS funds, equity linked savings scheme fund, mutual funds, which allow you certain deductions while also saving for your long term. Similarly, there's NPS, National Pension Scheme, which allows an individual to save over and above the limits of 80C. So that's something very few people are aware of, and I would urge everyone to look at it and then invest. Another one is insurance. If you're paying an insurance premium for your life or for your health, you also get a benefit of it, right? So these are few options available. Obviously, there are many more, but these are the key ones available for an individual.
Just now, Ankit, you mentioned about ELSS. I have heard a lot of confusion around this term, and its similarity and differences related to mutual funds. If you can shed some light on that.
Sure. So ELSS is nothing but a mutual fund. The only difference is it invests into equity and it has a lock-in period of 3 years. So if you have invested today for this financial year, you can't withdraw money from a ELSS fund for next 3 years. While in mutual funds, generally there are no lock-in periods. There might be certain exit loads, but no lock-in periods.
And what about the tax benefits around that?
Sure. So ELSS, as I mentioned, is specifically for tax saving. If you want to save your taxes, you invest in ELSS and you get deduction out of your total income.
And is there a difference in, let's say, we see the rate of interest that we get out of that?
No, so there is no difference in the kind of returns that you generate in both the schemes because the scheme works as per their philosophy of equity investments. So regardless of you're investing in an ELSS or a normal mutual fund, the returns would be more or less same. The only difference would be the lock-in period.
So, Ankit, my last question to you is, for an individual, what is the importance of any sort of insurances that an individual is going for in a financial year?
So there are two type of insurances that are applicable for an individual. One is health insurance and the other is life insurance. Both of these are tax deductible. So that means if you have paid, let's say 20,000 rupees as premium, you can claim a deduction of it against your total income. Now, how it work is you understand life insurance premium. So life insurance covers you or your family against an unfortunate event of your death, right? So any premium that you pay towards covering yourself, that is a tax deductible expense. Similarly, medical premium. If you're paying any medical premium to cover yourself or your parents who are dependent on you, then you get a deduction of that as well. So while it's an expense and it helps you cover your risks, it also helps you save certain tax. And that's why it's very important for an individual to go for both these insurances in their portfolio.
Thank you so much, Ankit, for that insightful session on financial year planning for the next financial year. I hope you guys loved this session. And if you guys have any questions related to the upcoming financial year or the kind of investments that you want to go for, you can definitely ask us in the comment section. If you guys like the video, do hit the like button, share the videos with your friends, and if you haven't subscribed, subscribe to Grip Invest.
Investments in debt securities are subject to risks. Read all the offer related documents carefully.